Telenor ASA is currently executing a significant geographical and operational strategic pivot, characterized by optimizing its mature, high-margin Nordic core while simultaneously simplifying and monetizing its complex, higher-risk Asian joint ventures. The company's immediate financial trajectory is underpinned by robust operational execution in the Nordics, which has enabled the tightening of the group's financial outlook for fiscal year 2025 EBITDA growth. The key investment consideration for Telenor is the structural conflict between high capital expenditure requirements necessary for 5G and fiber deployment, coupled with strategic Nordic consolidation through mergers and acquisitions (M&A), and the company's commitment to a generous dividend policy. This dividend, while high-yielding, is currently not fully covered by operational free cash flow, creating sustained pressure on the balance sheet. Quantitative Performance Summary, Q3 2025. In the third quarter of 2025, Telenor delivered solid performance. Group-adjusted EBITDA growth reached 5.4% year-over-year, YoY, driven primarily by 8% growth in the Nordic segment. Free cash flow before M&A saw a significant surge, rising 50% YoY to 4.2 billion. The stock currently trades at a latest 12 months LTM enterprise value to adjusted EBITDA (EV/EBITDA) multiple of 8.7x. The prevailing analyst consensus suggests a 12-month price target of 171.00. Investment thesis justification. The improvement in Telenor's forward guidance, projecting 5 to 6% organic growth in adjusted EBITDA for FY 2025, tightened from a previous mid-single-digit view, is fundamentally supported by realized cost efficiencies rather than acceleration in the top line. The financial results from Q3 2025 illustrate this operational leverage clearly. Nordic EBITDA growth of 8.0% significantly outpaced Nordic service revenue growth of 2.1%. This performance differential is due to management's ability to reduce operational expenses (OPEX) in the Nordics by 2.1% year-over-year. The successful execution of ongoing cost transformation programs, which allow EBITDA growth to outstrip revenue growth, is therefore critical to sustaining the investment thesis and supporting the company's capital structure over the medium term. The analysis concludes that Telenor represents a complex, neutral hold opportunity. While operational performance in the Nordics is strong and the stock exhibits attractive yield, the primary barrier to a strong buy rating is the capital structure risk associated with an FCF uncovered dividend, which is increasingly reliant on successful and timely infrastructure monetization efforts to stabilize the balance sheet. IV, Corporate Profile and Financial Performance Deep Dive. Group Financials and Operational Momentum. Telenor reported a solid third-quarter performance in 2025. Group service revenues totaled 16.3 billion, representing a 2.7% increase year-over-year. Adjusted EBITDA reached 9.5 billion, marking a 5.4% increase from the prior year period. The strength in operating performance translated directly into improved cash generation, with Q3 free cash flow before M&A hitting 4.2 billion, a substantial 50% year-on-year increase. Year-to-date, adjusted EBITDA stands at 27.5 billion, and FCF before M&A totals 8.8 billion. The strong operational results led management to tighten the financial outlook for the full year 2025. The company now projects 5 to 6% organic growth in adjusted EBITDA for the group, a refinement from the earlier mid-single-digit view. The target for FCF before M&A remains steady at around 13 billion. The underlying profitability of the group in Q3 was robust. Adjusted earnings per share was reported at 1.85, a 3% decline from the previous year. However, this dip was primarily attributable to a 500 million accounting adjustment related to the company's share in CelcomDigi. Absent this specific non-cash accounting effect, the underlying EPS growth would have been a strong 18%. This confirms that the operational profits were fundamentally healthy, obscured only by merger-related financial adjustments. Furthermore, the ability to achieve 5.4% growth in EBITDA from a more modest 2.7% increase in revenue underscores the effectiveness of current transformation activities and strict cost discipline, as demonstrated by the modest 1.3% overall uptick in group OPEX. Capital structure and leverage assessment. Management maintains a stated target range for its leverage ratio, net debt to EBITDA, between 1.8x and 2.3x. At the end of Q3 2025, the reported leverage ratio stood at 2.3x, placing the company precisely at the high end of its target range. Net interest-bearing debt, NIBD, excluding license obligations, totaled NOK 85 billion at the end of the quarter, representing a reduction of NOK 5.2 billion quarter-on-quarter. A crucial factor in this reduction was a favorable foreign exchange gain of NOK 1.1 billion, resulting from the strengthening of the Norwegian kroner against the company's key debt currencies. This reliance on currency fluctuation to manage NIBD introduces a degree of volatility into the balance sheet management process. While the company remains within its target range, depending on favorable FX movements for debt reduction highlights the structural constraint imposed by high capital demands. If the NOK were to weaken in subsequent quarters, the leverage ratio could easily breach the 2.3x ceiling, necessitating immediate management action to curtail capital expenditures or accelerate asset monetization to restore equilibrium. IV, segmental performance and strategic review. Telenor's operational strategy involves distinct management approaches for its mature Nordic operations and its high-growth, high-complexity Asian JVs. Nordic operations, the core value driver. The Nordic business segment remains the primary growth engine for the group. In Q3 2025, the Nordic cluster delivered solid results characterized by 2.1% organic growth in service revenues and a robust 8.0% increase in adjusted EBITDA. Performance across individual Nordic markets was strong. Norway was identified as the top performer, achieving 2.3% service revenue growth and 9.2% EBITDA growth, benefiting significantly from higher roaming revenues generated through the Lyse Tele roaming agreement. Sweden demonstrated a focus on efficiency, with a flat top-line performance due to fixed transformation initiatives, but still managed to grow EBITDA by 7.5% through improved gross margins and sustained OPEX efficiencies. This consistent outperformance of EBITDA relative to service revenue across the region confirms that profitability is being driven by operational streamlining rather than cyclical market growth. The strategic focus in the Nordics is consolidation and next-generation infrastructure deployment. Telenor is actively positioning itself to consolidate the market, as evidenced by the NOK 6 billion acquisition of Global Connect's consumer fiber operation in Norway. This strategic move is expected to boost Telenor's share of fiber subscriptions in Norway from 22% to 29%. Crucially, the deal is projected to yield $150 million in annual cost savings driven by backbone integration and scale efficiencies. The valuation ascribed to the Global Connect acquisition appears high when measured solely against immediate revenues, 600 million generated in 2024, yielding a 40x multiple on expected cost savings alone. This valuation is justifiable only if the company successfully realizes the anticipated operational synergies and leverages the long-term high multiple infrastructure value. Aligning with the premium valuations seen in other Nordic infrastructure transactions, such as Telia's tower sale at 27x EV/EBITDA. Successful synergy realization is essential for Telenor to validate its pricing strategy and reinforce its role as a strategic consolidator in the region. The commitment to continuous modernization necessitates high capital expenditure. CapEx, excluding leases, in the Nordic business is projected to account for approximately 14% of revenues. This sustained capital intensity is defensive and strategic, aimed at maintaining a competitive advantage in fiber and leading the 5G rollout. In Sweden, Telenor has already activated 5G across the entire mobile network through its network-sharing joint venture with Tele2, covering 99.9% of the population. Asian portfolio revaluation and restructuring. The strategy in Asia is primarily one of de-risking and monetization, aiming to simplify the portfolio and maximize returns from merged entities. The two consolidated companies in Asia reported combined Q3 2025 service revenues of NOK 4.3 billion and adjusted EBITDA of NOK 2.5 billion, reflecting organic growth of 4% for both metrics. Performance highlights include Gramophone, Bangladesh, returning to top-line growth despite persistent challenging market conditions, which included geopolitical instability. Telenor Pakistan also demonstrated strong operational growth, delivering a 17% increase in EBITDA, even as Telenor continues with its formal exit from this market, having received its first regulatory approval for the sale. However, the region faces potential headwinds. Management anticipates short to medium-term pressure on regional cash flows stemming from spectrum and data-related expenses. Furthermore, the major post-merger entities, CelcomDigi, Malaysia, and True, Thailand, are still in the integration phase. Network modernization for both JVs was 70 to 75% complete by the end of 2024. Although management expects integration costs to ease from FY 2025 onwards, Moody's assessment indicates that the FCF potential from these merged entities is not expected to materialize until 2025 at best. This temporal gap in FCF generation creates short-term pressure on the group's cash requirements. This dual market structure confirms Telenor's harvest and invest model. The high-quality Nordic cash flows secured by strategic investments fund the current business and allow for the calculated de-risking and simplification of the Asian portfolio. The reliance on Asia shifting from a revenue source to an eventual FCF source means that any delay in synergy realization in JVs like CelcomDigi and True is significant, as it postpones the structural solution required to address the group's FCF deficit. Dividend policy, free cash flow coverage, and capital allocation. Dividend sustainability and payout profile. Telenor's stock is known for its high yield, with a forward dividend yield reported at 5.49% as of November 2025. However, the commitment to this payout is not fully supported by current earnings, resulting in a payout ratio of 139.41%. The assessment of dividend quality is highly cautious. The company's dividend strength score is rated as weak, grade D, score 28 by AAI, primarily due to the unsustainable earnings payout ratio relative to the sector median and resulting low dividend sustainability score. This structural issue is underscored by the historical performance of the dividend. The average growth rate over the past 3 years has been negative, at negative 2.01%, indicating a lack of consistent, robust growth despite management's stated ambition for continuous dividend growth beyond 2025. FCF deficit and debt trajectory. The structural strain on Telenor's balance sheet is clear. Moody's analysis projects that the company's dividends will not be fully covered by operational free cash flow through 2025. This shortfall necessitates financing the dividend through other means, contributing to a negative overall debt trajectory. Consequently, Moody's expects adjusted leverage to remain in excess of 3x through 2025. The high payout ratio, above 100%, confirms that the company cannot finance its current level of shareholder distribution purely from internal operating cash flow. This creates a critical need for capital generation from external sources, namely infrastructure monetization. Infrastructure monetization and use of proceeds. Telenor has pursued the strategy of monetizing minority stakes in its infrastructure assets, e.g. fiber and towers, while maintaining control. However, the proposed allocation of these proceeds raises questions regarding balance sheet prioritization. In the case of the partial disposal of the Norwegian fiber business, the cash proceeds were designated not only for strategic investments and balance sheet strengthening, but also explicitly for shareholder remunerations, specifically share buybacks. The practice of selling long-life, high-multiple infrastructure assets to cover current dividends represents a form of financial engineering. It effectively trades stable, long-dated future cash flows for short-term shareholder payouts. While this action supports the immediate share price and yield, it inherently reduces the future quality and predictability of the group's operational free cash flow, prioritizing short-term investor return over structural deleveraging. The persistence of the FCF deficit places the commitment to dividend growth in direct conflict with credit quality goals. The company is maintaining a high debt trajectory because it must borrow or sell assets to fulfill the dividend commitment. This is why Moody's projects adjusted leverage to exceed 3x, despite the company's stated operational leverage target of 1.8x to 2.3x. Investors are effectively being compensated via the high yield for accepting this higher inherent balance sheet risk. Valuation and peer comparison. Absolute valuation metrics. Telenor's valuation metrics reflect a mix of operational stability and geographical complexity. The stock's PE ratio is approximately 22.13x and 22.4x for the OSE listing, which is somewhat elevated for a mature telecom operator, though this figure is partially distorted by the non-cash accounting adjustments related to the Cellcom-Digi merger in Q3 2025. A more instructive metric is the enterprise value to EBITDA ratio. Telenor's latest 12 months LTM EV to EBITDA stands at 8.7x. Historically, Telenor operated at a median EV to EBITDA of 7.6 from 2020 to 2024, suggesting the current valuation is trading slightly above its recent historical median. The market capitalization for the OSE-listed stock is approximately NOK 215.7 billion. Relative peer benchmarking. A comparison with regional peers highlights the market's pricing of risk and asset quality. Telenor's LTM EV to EBITDA of 8.7x appears attractive when compared to Scandinavian peer Tel2, which trades at an LTM EV to EBITDA of 12x. This discount applied to Telenor likely reflects the added complexity and higher geopolitical risk associated with its Asian JVs, as well as the immediate challenge of the FCF deficit. Crucially, Telenor's operational multiple should be viewed against the intrinsic value of its infrastructure assets. Pure infrastructure transactions in the Nordic market attract significantly higher valuations. For instance, Telia successfully monetized a 49% stake in its Norwegian and Finnish tower business at an implied EV to EBITDA 20 multiple of 27x. Telenor's current valuation applies a blended multiple to both its lower multiple operational business and its high multiple infrastructure holdings. The disparity between the company's operational multiple, 8.7x, and the infrastructure transaction multiple, 27x, suggests a conglomerate discount is being applied by the market. The pursuit of minority stake monetization is therefore a strategy aimed at crystallizing this hidden infrastructure value. The successful sale of fiber or tower stakes at high multiples would justify a higher blended group multiple and serve as the most significant re-rating catalyst for the stock. The lower EV/EBITDA relative to Tel2 also signals the market's valuation sensitivity to Asian risks. Tel2, focused primarily on the Nordics-Baltic region, is viewed as carrying lower geopolitical risk. Telenor's exposure to complex post-merger integration in Malaysia/Thailand and volatile environments like Bangladesh warrants a discount. The successful completion of the Pakistan exit and the materialization of FCF from the large JVs are crucial de-risking milestones that are needed to narrow the valuation gap with Nordic peer plays. Analyst consensus and price target. Telenor holds an average brokerage recommendation, ABR, of 2.50, calculated from the recommendations of 12 brokerage firms, positioning the stock broadly as a hold/buy. Out of 17 analysts tracked, 7 recommend buying, 9 suggest holding, and 1 recommends selling. The average 12-month price target is NOK 171.0. Relative to recent trading prices, this suggests a potential upside of approximately 13.55%. The forecast range is wide, extending from a low of NOK 138 to a high of NOK 210. V. Risk assessment and sensitivity analysis. Capital and financial risks. The primary financial risk stems from the reliance on non-operational cash generation to cover shareholder distributions. The structural risk that FCF will remain insufficient to cover dividends through 2025 creates persistent pressure on leverage and limits financial flexibility. This necessitates frequent evaluation of the company's infrastructure monetization strategy. Uncertainty continues to surround the timing, size, and ultimate use of proceeds from future infrastructure sales. If these sales are delayed, or if the proceeds are primarily directed towards shareholder remuneration, as seen with the Norwegian fiber disposal, rather than immediate debt reduction, the goal of maintaining leverage below 2.3x could be missed. Furthermore, if the FCF potential from Asian JVs slips beyond the 2025 timeline, the reliance on asset sales to cover the dividend becomes absolute. This heightened dependency introduces a material binary risk related to the dividend sustainability and leverage management. If asset monetization fails to deliver quickly or at attractive valuations, the company would be forced to either cut the dividend or rapidly increase debt, potentially triggering a credit downgrade. Operational and competitive risks. In the Nordics, Telenor must manage continuous competitive tension, particularly in Finland and Sweden. While Telenor has demonstrated efficiency gains, high Nordic EBITDA growth from OPEX control, maintaining this operational leverage requires ongoing aggressive cost management. The high capital intensity, 14% of Nordic revenue projected for CapEx, mandates flawless execution of 5G and fiber deployments to ensure a strong return on investment (ROI) from expensive infrastructure rollouts. In Asia, the core risk is associated with M&A integration. The complexity of merging Celcom, Digi, and True is substantial, and although network modernization is nearing completion, 70 to 75%, the realization of promised synergies and positive FCF distribution has been delayed. This delay constitutes a risk that capital expenditures invested in integration may remain unproductive for longer than anticipated. Geopolitical and regulatory risks. The Asian portfolio introduces significant geopolitical and regulatory risks. Political volatility in markets such as Bangladesh, where anti-government protests recently impacted Grameenphone, poses a risk to asset security and cash flows. Closer to home, the Nordic core faces elevated threats. Geopolitical tensions, extreme weather, and increasingly sophisticated cyber attacks are placing critical Nordic infrastructure under pressure. This risk requires Telenor to be constantly vigilant and may necessitate unplanned or accelerated security-related CapEx spending, potentially impacting FCF targets and capital allocation flexibility. 7. Conclusion. Synthesis of analysis. Telenor ASA presents a nuanced investment case. The company's core operational strength lies within its Nordic segment, which exhibits robust EBITDA growth driven by strategic cost discipline and efficiency. The overall corporate strategy is coherent, focusing on solidifying the high-margin Nordic base through consolidation and de-risking the high-complexity Asian JVs. The stock currently trades at a blended operational multiple, 8.7x EV/EBITDA, that appears reasonable but likely obscures hidden higher multiple infrastructure value. However, this strength is critically offset by the fragile capital structure. The dividend policy, resulting in a payout ratio exceeding 139%, is unsustainable without external financing and contributes directly to the FCF shortfall projected through 2025. This reliance forces management to deploy proceeds from asset sales to cover shareholder returns, thus perpetuating higher leverage, 2.3x reported, greater than 3x Moody's adjusted. Execution risk in Asian integration and ongoing geopolitical volatility further complicate the outlook. Investment recommendation, neutral/hold. The analysis suggests a rating of neutral/hold. The attractive yield and operational stability of the Nordic segment are balanced by the high balance sheet risk inherent in the FCF uncovered dividend. Telenor is best suited for income investors willing to accept elevated capital structure risk tied to M&A and asset monetization execution. Catalysts for potential upside, shift to buy. Successful monetization. The company executes a large-scale infrastructure monetization, for example fiber or tower stakes, at a high valuation, 20x plus, with the majority of proceeds demonstrably directed towards significant balance sheet reduction and deleveraging. Early FCF realization. FCF from the major Asian merged entities, Celcom, Digi/True, matures earlier than anticipated, structurally resolving the FCF coverage deficit. Downside risks warranting sell. Dividend policy failure. The company misses its FY 2025 FCF target, leading to a mandatory dividend cut or rapid expansion of the leverage ratio above 2.5x. Competitive erosion. Intense Nordic competition compromises Telenor's ability to maintain high operating margins and efficiency gains, reducing its primary source of cash generation. Geopolitical events. Significant adverse regulatory or political events in core Asian markets, for example Bangladesh, compromise asset value or repatriation of cash flows.